Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Orient Electric, which has come up with mixed sets of numbers, and let's understand how the valuations are stacked up and whether you should invest in the company or not. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Now about the company. It was established in 1954 and this has pan-India presence. And what does Orient Electric do? Orient Electric produces fans, switchgears and lighting. They also export to 35 countries worldwide, and it is also a part of a DeLonghi group which also owns Kenwood and Braun. Braun, remember, produces women electronic products, whereas Kenwood is a very big brand abroad in terms of wood, plywood and planks, etc. Plus, Orient Electric has also started selling its products online on their own portal rather than on Amazon or Flipkart, etc. And it is also doing well. They have a brand name in the name of MS Dhoni as their partner. So, this has also helped in increasing the sales numbers. The financials September 19 numbers have come in. So FY20 or September 19 numbers, the sales were up 15.5%, but the profit was down 28%. And that's why I'm saying that these are mixed numbers. It is a high debt company, which it should not be because it is a consumer company. It's a consumer goods oriented company, but yet the debt is high, but it is reducing quarter on quarter. I've seen that reduce if you look at the balance sheet. The net profit margin currently stands at 11.3%. It was around 13% about a year back, so it has also come down a bit. So about the valuations of the company, currently it trades at 52 times earnings. So I would say a little bit expensive at these valuations. Orient Electric is, although this is a consumer durable brand, so it can trade at 50-60 times. But considering that how much debt the company has, along with the kind of numbers they are producing, to trade at 52 times looks slightly expensive. There is a high institutional and DII holding, although the promoter holding is low at below 40%. Yet the institutional and DII holding is so much that only 14 or 15% is with the general public. So in that regard, it is quite fine. Currently trades at near 52-week high, so one needs to take that into account that the stock has already run up a lot, and as I said that trading at over 50 times earnings with results which are going down in terms of profitability, it doesn't feel quite comfortable to invest in, but it is a consumer durable play, as I said. So why the results were bad, or why the results were so not so good on the bottom line? The raw material cost has escalated for Orient Electric. So cost of acquiring the materials to produce the fans and electric switchgears, etc., has increased. Other costs or other expenses has also increased appreciably from last year. And hence we are stuck with lower margins, and margins have reduced because of higher competition as well. So there is competition from other consumer durable brands. As we know, there's Lloyd, there are others like V-Guard coming into consumer durable section apart from producing stabilizers. Plus there's Havels, there are other brands, there are many brands, many local brands also. So there's high competition in this segment, and hence the margins is set to reduce further going onwards. And one of the most important point I want to stress here is that 14% shares of theirs is pledged at the moment, although there was 0% shares pledged last year. So in the last 1 year, or last, you would say, 2 to 3 quarters, it has been revealed that around 14% of their shares are pledged. Hence I believe that you have to be a little bit circumspect in order to invest in such a company in which the shares are pledged. Although the pledging of shares are not too huge and it's not a negative thing. uh, there are many companies, many marquee brands here in India who have pledged shares between 10 to 30%, yet they are trading at 52-week high and are regarded as one of the best companies in terms of corporate governance. So it is not that just because of the shares being pledged in a company that the company goes very bad, but you have to be a little bit careful and dive deeper into what is in terms of the price of the pledging of shares, although it is very hard to find out, etc., and look at the management pedigree before you invest in such a company. So, as I said, heavy competition is also taking a toll on the profitability because the margins have shrunk and they needed to reduce prices in order to get their sales up. That's what I feel has happened, although there is no official word on it, and that is probably why the sales have went up, but the profitability has reduced. So what needs to be done? I would say you need to avoid at these levels at around 50, 52 times. I would say it's an avoid. We could see a market correction over the next 1 year or so, 18 months or so in these kind of stocks where the valuations have run up and the results have not shown pedigree. And also especially in stocks which are related more to the large cap and mega cap section, you need to avoid, although this falls under mid and small cap, yet the valuations are expensive. Yeah, if you ask me. uh, you should only invest 5% of your total portfolio, never invest more than that, so that you, if you lose all of it, you'll have 95% staked for you. And let stocks correct and results improve. So if the results doesn't improve in the next couple of quarters, that means the next 6 months, we could see the stock correct between 30 to 50%, and we have seen that happen in many mid and small caps. So this 200 rupee share could easily become 100 rupee, and I'm not saying something which is very startling. uh, Even at that pricing, it would trade at 25, 27 times. If the result stays where they are, if the profitability reduces further, then the PE of the stock would be around 30, 35 times, which is reasonable considering the kind of profitability the stock is showing. But at 50 times it looks extremely expensive, hence you need to let the stock correct. And I would suggest this to all the viewers here, and that never buy a stock, even if it is Pidilite, Reliance, anything, which never buy a stock which is making 52-week high day after day. Let the stock correct, even if it corrects by 10-15%, you'll have a better margin of safety when you invest in that manner. And you buy the best in the business. So if you want to buy something into wires, cables, etc., Havels, we all know, is a marquee brand. I'm not saying you buy Havels and sell this, but look for top level companies in this segment rather than buying second, third ring. And I have said that many times, so why you need to do that. And if you currently hold this stock and you're making money in it, hold on to it. Probably do not sell it, and probably add on to it when it declines. Don't expect it to run up sharply over the next 1 year. I think there could be a little bit of correction in the stock, minimum 20 to 25%. So this was our video on Orient Electric. Please like and subscribe my channel, hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.